All right, I'm going to share my screen. Tell me, are you able to see my screen?
Yes.
All right, good. So if anybody else joins in, we would see it should pop up that somebody is in the waiting room, but you can just monitor the chat just in case somebody's not getting through. All right, so tonight we're going to be looking at the head and shoulders pattern. It's very effective. It's a short presentation. It's just about 16, 17 slides. It's just this one strategy, but it is a very, very effective strategy. Just as we've been learning some of the other strategies, the other patterns, if we learn to trade them, we can trade them and trade them well. Again, some persons just spend time mastering just a few of those patterns. But if you spend time going through it, you'll realize some are fitted for different kinds of market conditions. And based on the market condition, we can choose a pattern that works. So we look at the head and shoulders pattern. And see exactly what it looks like here. This here would be our support. This is going to be our support line, and key for any of the strategies as we normally go through, the area of support or resistance is always a key area. So the very first thing you do when you mark your charts is always to look for support and resistance area. So this is our support and resistance area here. It's now acting as a support because we see what happens when price bounces on it here. Which is called the neckline in that case, because we're talking about head and shoulders. So what is above here, that's our head, which is higher up, but we have our left shoulder, right? And this indicates the market going up, market coming down. That is with the different color arrows here. This forms our left shoulder. Then it goes higher up, which forms our head. And then we have our right shoulder being formed here. And then it comes down, crosses our area of support, and then we see we have the break, the retest as normal, and then we have the continuation of that trend. So with any of the strategies, remember it's always once we break, we do a retest, and then we continue on this year. The thing about it, when we're doing this here, it's easy to identify because it has already been identified for you. It takes a little while to look at the chart. It takes a little while to look at the chart to be able to spot on, just identify those. And once we get to the stage of being able to identify it, then all should be well. All right.
Mr. Paul.
Yeah.
Renelle said she's not getting in.
Yeah, she's in now. She's in. Right. So what is the head and shoulders? The head and shoulders pattern is one of the most popular patterns and best known price patterns in Forex trading. This is a very accurate trading signal if you know how to use it properly and flexibly. The head and shoulders, as the name, or is the name of a special type of price pattern that usually appears at the end of uptrends. This is a signal of future downtrends, right? So it is found at the end of an uptrend, and it signals that the trend is going to change. So it went up to the head. We have the shoulder being formed first. Then we have the head and the right shoulder being formed. And then it breaks that neckline, which is our area of support, and eventually goes down into a bearish direction. It is called head and shoulders because the shape of this pattern on the price chart is similar to that of the human body, including left shoulder, head, and right shoulder. Left shoulder, head, and right shoulder. That's why it's called the head and shoulders. So we have here our neckline again, which is an area of support. The market goes up, comes down to that area of support, the neckline. It goes up, it forms the head, it comes down, it forms the right shoulder. we have the breakout. We have the breakout from the trend. After it breaks out, we have the retest, and then it continues. And if we see that pattern clearly being formed, and you're in the market, so when you get to the market or when you get to your MetaTrader platform, you realize the market might be around this time here. It's a very good idea to wait for the trend. And once it retests on that level here, you know you can get in for the sell, maximize on the amount of pips you can make in this trade. The line connected on the chart here.
I just took the man killed Friday. This is America, man.
Second.
This is a one dance. It's not like one time we just watch one day, this train is here just
the line connecting the two troughs of the shoulders is often called the neckline. In fact, this pattern is perfect when the neckline is horizontal. The prices of the two lows are approximately the same, right? So we can have that being formed in various conditions. We can have it here, but be it formed diagonally when the market is, well, we're going to see it as we move on. But the best area we have, the most effective way, is when it forms on a horizontal level. So we can compare the neckline, and if on both left and right shoulders they are identical, it gives us more confirmation. Normally, when the pattern appears, the market will offer a retest or pullback point. If you do not understand what retest is, well, we've had that in other articles, right? But retest simply is just going back to that area of support or resistance that was broken, right? So this pattern has the following characteristics. We're talking again head and shoulders. The stronger the price increases before the pattern, the stronger the price falls after it. It's important. Sometimes it takes a while to get up there with not much price action. The market might be a little bit slow, less volatile. But this is saying the stronger the increase, the more volatile, the more the price action is up on that trading platform here, on that pattern, the stronger the price is going to fall after. There is a lot of volume in the market and the price is moving up and eventually the price is going to fall. It is going to fall hard. All that goes up would come down. But likewise, if it goes up with speed, there are times it comes back down most of the time with a lot of speed. So the faster the price increases before the pattern, the faster it falls after it. So once we can identify those patterns and we see the sort of a formation to know or get an idea, so how long it would have taken to form that pattern, we have a fair idea as to the rate at which it is going to fall. The variation with a neckline pointing upward offers the highest accuracy. Left shoulder higher than right shoulder yields a better performance. So think about it. If your left shoulder is higher than the right shoulder, why would it yield better performance? Because by the time the right shoulder is formed, we realize if it went higher, it would signal there are a lot of persons in for the buy, in for the bull direction. But if it forms a little lower, it tells you, it gives you more assurance that the bears are taking over. There are less buyers in the market, because remember, the head and shoulders is really a signal for a downtrend. So if the right shoulder forms a little lower than that of the left shoulder, then we know we are heading for a better downward movement. Let's look at this in reality here now, in real time. Again, it might be easy to identify. Why? Because it's already identified for you and the lines have already been drawn. So learning to identify these patterns is key. So you have the market coming all this way here. Look at what happened here. Look at something in the market here. Look, we had this one candle here with such a steep fall. This one candle, but just with the speed that candle went down, we look at the candle that formed after. As soon as this candle closed down here on the next hour, the market would have moved right up. almost back to where it was. So we had this formation being formed here. We had this here being formed. We have our area of support. If this line here was extended all the way, look at what's going on here. Look at this area here. We can also see that this was acting as a resistant area. That area here was acting as resistance here. Now that area is an area of support. So our left shoulder is formed, our left shoulder. So the market went up. Remember, the left shoulder is being formed in an upward direction. So our left shoulder is being formed. Then the market comes back down. It comes back down and it meets that line of support. What happens? The market went back up higher than the left shoulder. This is forming the head region. What happens? The market comes back down. And after the market comes back down, right back to the point where the left shoulder was formed. What happens? The right shoulder is being formed. The market went back up to that area of resistance here. And then the market would have broken out, break out through the neckline area and started the descent. So it's really being able to identify those patterns there. It's really being able to identify those patterns. Again, our left shoulder is being formed. It always starts from an upward movement, upward. And remember, the head and shoulder pattern is a signal for a change in the market also, because we're looking for a sell. So with the upward movement, it went up from the left shoulder back down to the area of support, or which we call the neckline. And it's only called the neckline in this case because we're talking head and shoulders. Then the market goes all the way back up to form the head, comes right back down to the neckline area, try going up again, but it still couldn't go back up in that direction. The bears would have taken over, selling, and then we had the breakout of the neckline and the market would have gone down. And we look at it, it looked like though it's a short movements, but based on the time frame, it is quite a lot of pips that will be collected in that movement that we look at. Again, we look at it the horizontal. So this is our horizontal. And we say this horizontal one gives us the most accuracy when we're talking head and shoulders. There are various types of head and shoulders. So let's look at the common types of head and shoulders. A perfect head and shoulders pattern rarely appears. Therefore, traders usually consider the variations of this price pattern. Here, we'll look at the other two popular remaining types. These are the patterns with an upward neckline or a downward neckline. So let's take a look at the image, the next slide, and we're going to see, right? So let's just look at it and we're going to come back to that slide here. So we are looking at the neckline, not horizontal as the one we did before, but it has a slight tilt towards the upside, right? So let's go back here. So the variant we're looking at now is the upward neckline. This is a variant with an upward neckline. This price pattern offers the highest accuracy among all head and shoulders pattern, right? It offers the highest accuracy among all head and shoulders pattern. So let's look at it here. So we have the price moving from low to go up. So that's our price going to form the first shoulder, left shoulder. Price came back down here on that area here, on that neckline area. The price bounces, it goes a little bit higher, comes right back down to that same area, went back up, didn't go as high as the head. That's why we have the right shoulder being formed. And when price came down this time, price would have broken out of that area of support on neckline here, break through it. But as usual, what do we have? We have the break and then the retest. And then we have the retest coming and the market moves down. Again, it would be a nice thing if we catch this when it happens, maybe when the market is around that area here, or even once it makes the break. We have our line of that line here, support, which we call the neckline in this case. And our retest, once our retest goes back to the line, we can get in now for our sale, and we can maximize on the amount of pips we're going to collect, right? So this is that diagonal head and shoulders. So let's see it in action. So we could look at it for a while and observe how price was moving all the time, Price came from below here. We have a doji candlestick here too also. Price moved from here. Price went up. Price came down. Price went higher to form the here. Price came back down. Price goes up to form the right shoulder. We have a breakout here. The retest didn't go all the way back up to the line here, but then it just descended. So again, remember, it is not always a horizontal line support we're looking for, or the neckline, but it can be in this form also. So it really begs for us to take some time to look through the charts so that we can be able to identify those patterns. Because if we're not able to identify them, we just look at regular candles, just up and down candles. Or I didn't see anything there. Matter of fact, it just go up because the market go up, and down because the market goes down. But when you spend some time looking at it and you can pull out from it, you can identify the various patterns from there, and you become one who trades with the pattern. It's a more efficient and effective way for your trading. You know, there's a popular guy on YouTube. I followed him quite a lot before. He's the pattern trader. And basically what he does, he just looks for patterns. That's all he does. He looks for patterns. And once he identifies the patterns, he just go ahead and trade with them, because these patterns have been tried and tested and they are very accurate. So instead of always just, okay, we draw a support or resistance, we do that, we wait for the break, we wait for the retest, and we do that, and we are successful. But if we have mastered the various patterns and see how effective they are, knowing when to trade them, how to trade them, we can be more successful with the trades that we do. All right, let's go to the next slide. So this pattern we did was with an upward neckline. Now we are doing this other pattern here now with a downward neckline. Similarly, we also have another variant with a downward neckline. Then the neckline will look like a trend line in a downtrend. You need careful observations to identify this pattern. It's a lot of practice to get that. So look at this here. So this is more or less like the trend line, and we're watching what's going on here. So the market goes, breaks it, retests on the trend line. That's our left shoulder being formed. We go up here, higher up, that's the head. It comes back down on the trend line, or as we call it, the neckline in that case, area of support, goes back up to form the right shoulder. But look at here. We have the breakout, and then we have the retest, and the market goes down. Remember, the head and shoulders pattern, as we're looking at it, it is for a sell, it is for a downward movement. So the market would have changed direction from an upward or from the bullish condition to the bearish condition, right? So we must know that the pattern doesn't only form horizontally, right? We have it can be happening with a neckline that is upwards, or even in that case here now, a neckline that is downwards. So let's look at it in a practical way. You know, it might be difficult to identify if we remove the drawing, because just look at the chart in that fashion, just look at candles going up and down. But look at what happens here. The market went up, it came down to that area. It went up, it formed the head, came back down a little lower. But because we would have drawn our trend line here, we realize what's happening here. It went up and we had the breakout here. We had the retest, and then the market went down. So this here is on a downtrend, right? Downward. Previously, we had the upward. Then we also had the horizontal, right? Okay, good. So how do we trade using those here? All right, somebody is in, somebody wants to get in. Let's go back. One second, somebody wants to come in. Right. So since this is a pattern signaling a price decrease in the future, you should only open down orders with this pattern. Again, remember, we say that the head and shoulders pattern, it's really as for a sell or a downward movement. So once you identify the head and shoulder pattern on any chart, you are not making any entry for the buy, right? All we're doing, we're going short position. We're not going any long position. We are going for the sell. So we are waiting until the right shoulder is complete. We have the breakout from the neckline, we get a retest, and then we go for the sell. So always with the head and shoulder pattern, be it the horizontal or the downward or the upward neckline, once it breaks, we're always looking for the sell, right? So the entry point is right after the candlestick breaks out of the neckline. Our stop loss is at the peak of the right shoulder. So it breaks out here. That's why it breaks out here, right? We have a breakout and we have a retest here before it moves down. Our stop loss is going to be at the peak of the right shoulder. So this is where our stop loss is going to be 10 to 15 pips away from the top of the right shoulder. So this is where our stop loss is going to be. Remember, the market was going up, it retested. It went high up, it came back down to the here and retest. It went, but it didn't go as high up as before. That's why we identify the head and shoulder pattern and then on the breakout. So we can safely conclude that in the event there is a pullback or retracement, it would not go above the height of the right shoulder. And because this is tilting downwards, then that higher level on the right shoulder is not as high as that on the left shoulder, or in the case if it was a horizontal head and shoulders pattern. Our take profit, usually head and shoulders is a pattern for starting a downtrend. Therefore, instead of setting a take profit, you can adjust your stop loss when the price falls. The lower the price is, the lower your stop loss, and you should adjust. This is to maximize your profits and protect your final results. What is that really asking us to do here? That last part here, right? It is the starting of a downtrend. So if it tells us, instead of setting a take profit, we could adjust our stop loss. What is the best alternative?
Set a trailing stop loss.
We set a trailing stop loss. But again, now the question can be asked, how soon should we set a trailing stop loss? You know, we can do pending orders. Should we do a trailing stop in that case, since we are uncertain, even if we decide to do a pending order for a sell, let's say a sell stop here, should we start that trade with a trailing stop loss?
No.
Why shouldn't we?
Because there's still a chance that the market could retest and go all the way up. Yes,
very well. So when then is an ideal time to do a trailing stop loss?
I would say probably when your first TP is hit.
So, okay, you're in a downtrend. When your first TP is hit, you decide to do a trailing stop loss. How far back should your stop loss go then, your trailing stop loss?
10 to 15 pips above your above the previous TP.
Okay, right. So then let's get a visual, right?
Okay, sorry, I'm not meaning to cut. Mr. Millet, sorry. It's the same stop loss thing. So you're saying I usually sometimes open a trade and I put a trading stop loss when I open it. So if I put a trading stop loss of 20 pips, it's not the same as putting a stop loss of 20 pips, a manual stop loss of 20 pips?
Yes and no. Let's look at it practically on this chart here, right? Okay, good. So this is our right shoulder. This way it breaks out, so we enter the trade, right? So let's say we enter the trade here. And let's just say, for example, the top of that shoulder is 20 pips. So our stop loss is 20 pips, right? So we put our stop loss for 20 pips, fine. The market comes down, comes down, comes down. We make 10 pips. So the difference, the distance between the market now at 10 pips down here and our stop loss is now 30 pips, right? Because our stop loss is 20 pips. And now we have 10 pips gain. Our stop loss is 30 pips away. So now the market is at the bottom down here. We have 10 pips gain, but our stop loss is 20 pips. So right now, in the case price has to pull back, price could go as far as 29 pips pull back and not throw us out, close the trade, go as far back as 29 pips and then come all the way down here and we're still in the trade.
Okay, I understand now.
Right? So we enter here, our stop loss is up here. The price reach all the way down here, 30 pips, and you decide to pull back. It can pull back 58 pips and then continue to come back down. But here's what's happening here now. You enter here, and yes, your stop loss is 30 pips, but you put a trailing stop loss for your stop loss is 20 pips, and you put a trailing stop loss for 20 pips. What is going to happen is that when you go down, price goes down here, 20 pips, your stop loss would now be right where you entered. What happens if price goes back up, let's say 10 pips above where you entered? It's throwing you off early. That trade is going to be closed out earlier. The price comes back a little and then the price goes down. So it is not a wise thing to open a trade with a trailing stop loss. So
I understand.
When do we do a trailing stop loss? Here. We enter the market here. This is our stop loss right here. We're safe with that. The market goes down and it hits our TP1. Once it hits our TP1 here, okay, fine. So we had a little retracement, fine. The next candle starts here. When the market decides to move down here to protect us, we move our stop loss now from here where it was, and we put our stop loss at our point of entry. So now the market is all the way down here. So we would have had, let's say, initially we started with 20 pips stop loss. Now we made 30 pips. Our stop loss now is at entry point. So this is a no risk trade.
Right. So that's a manual one though, and still not.
Yeah, that's a manual one. Okay. So we move it here first here, right? So this is here. So our stop loss is here, the market is here. The market decides to go down and go down. When the market hits our TP2, we can now move our stop loss manually into TP1. So we already secured that. So in the event that the market pulls back, so look at this. So the market moves here and we have our stop loss at TP1 here. Look, the market pull all the way back here, just a little below TP1. So we'd have lost that 60 pips we make here. We went back down to around 35 pips here. But the market is going to continue coming back here. Had we done a trailing stop loss, since the market started coming back, when the market was down here, our stop loss moves down here. And once the market, remember, with the trailing stop loss, the stop loss never goes back up. It stays there. So we still monitor, but by the time we cover our second TP, going into our third TP, then it's a safe time to do the trailing stop loss. So cover 2 or 3 TPs first before you do the trailing stop loss, because the market can always pull back, but you don't want to open a trade with a trailing stop loss. As soon as you hit TP1 and you realize it starts heading for TP2, you move your stop loss into break even 0, the point of entry. So matter of fact, even though it pulls right back, you haven't lost anything. You cannot lose in that trade. Once it hits TP2, you move your stop loss into TP1 and you monitor the trade, right? So the trailing stop loss is really when you think you would have gotten enough out of the market. You say, you know what, just in case, let me put a trailing stop loss. So I just get a little extra. In the event I don't get the extra, even if I lose, I wouldn't lose much. But you want to at least cover 2, 3, 4 TPs before you actually put in a trailing stop loss. Right. So I want to go over that part here with this here. Usually the head and shoulders is a pattern for starting a downtrend. So once you catch it, it takes a while to go because it's a new trend that is being started. So it's not just saying, oh, just take 10 pips or 20 pips. It's a new trend that is starting. So you can cover some grounds with this, right? Therefore, instead of setting a take profit, you can adjust your stop loss when the price falls. So you can manually adjust it. Because it is the start of a trend, that's why we can manually adjust it. But what we can do, we just said, instead of always having to manually adjust it, we may not be there to physically adjust it all the time. So we put the trailing stop loss, so the trailing stop loss handles that for us, right? So the lower the price is, the lower your stop loss, and you should adjust. This will help us to maximize the profit and protect our final result, because it doesn't make sense that the market pulls down 80 pips, 100 pips, and we still leave our stop loss right where it was originally. So you would have made that 100 pips and the market reverses and you would have lost all that you would have made. So if you decide to work with stop loss between your TPs, that is also a good option, right? So hit TP1, my stop loss is on break even where I entered. You hit TP2, I move my stop loss to just a little above TP1. You hit TP3, I move it just a little above TP2. You hit TP4, and you can play it so if you have the time to do that. But when you don't have all this time, after you hit TP3 or TP4 or TP2, based on what it is here, you do your trailing stop loss. But I would think a trailing stop loss is more effective after TP3, TP4, because the market can always retest areas that it would have hit before. Right, so practical example. This is price action here is moving, it's coming from going in an uptrend. This would be an area of support. It went above, it came down. This is our left shoulder being formed. It goes up, come down. This is our right shoulder being formed. It come up, and then the market went down. So look at our point of entry. That's our neckline here, our support area. Once it breaks it here, break it through, look at it, it break it through, it retested with this candle here, so we entered right here. Our stop loss is above the right shoulder. Look what happens. The market came down, pulled back a little, it came down, retraced a little, and down all the way down that side here. It retraced quite a lot before it continued to come lower, and the market was playing here. So if by the time it hit TP1 here, TP2, look at it here, TP3 would have been down here, and hit TP4. So by the time it hit here, look at it, it got here. If you have a trailing stop loss, say just down, down, it went back up, but it wouldn't have hit our stop loss. It went all the way down to that point. But when it started rising, coming back up, by the time it reaches here, it would have closed the trade. But when the trade closed, we would have already had 3 or more TP inside in the market here, if we would have done a trailing stop loss, right? So it's just a matter of knowing the amount of time you have. If you have time and you're available, you can manually move your stop loss. It's just a matter of just dragging the line and drop it. Or if your time is limited, you can do a trailing stop loss, but do not do the trailing stop loss too early in the trade, because the market itself retraces and it can show you off very early and you miss the opportunity to maximize. Because knowing the head and shoulder pattern, it is a very accurate pattern, very, very accurate, which signals again the change of a trend. And even if the trend is changing, like in that case here, changing to a bear trend, it doesn't mean that the bulls are going to give up. That's why we have those kind of retracements coming back. So yes, the trend is changing, but those in for the buy, they wouldn't give up. They're going to still try to push for the buy, push for the buy. Here, look at this candle here. We see it's like a doji candle, always green. It has a little up, it closed a little above where it open, but it still shows even at that point here. Now we ain't going higher. Look at that high wick up here again. This wick tells us what's going on. The market ain't going higher. And then the market pulled down. And we have this full doji being formed here. But all here what's going on is real kind of indecision. Why? Okay, look at this candle here. Nothing much happened. Okay, we have a little up on this candle. But look at these 3 candles here. they all are showing you some level of indecision in the market. So looking at this continuing, that would have gone, that maybe the most likely that would have gone down, because again, the head and shoulder pattern tells us that it is a change in trend, shifting from an uptrend into a downtrend. So to conclude on this here, the head and shoulders pattern is a favorite signal of price action traders. This is a strong signal for you to open trend or trendy sell position. Remember again, we don't buy using head and shoulders. It is always a signal for a downtrend. Often the head and shoulders warns traders of a strong downtrend in prices. So let's go back and see something here. If it warns you, so remember, it signals a change in trend. So the trend changes at the head and shoulders, right? So this is where it changes at the head and shoulders. But remember, since the trend just changed here from an uptrend into a downtrend, you're still going to have a lot of uptrenders. You're going to have persons who are still buying in the market. And that's why we are encouraged, even in the slides here, that we manually move our stop loss, because at any given time, we can still have buyers getting back into the market to fight it here. So as that trend continues, you're going to see it going low, down and down and down. But early up in the change of trend, because remember, okay, we were in for the buy and we are going up and making money here. And then the sellers decide to push the market down. Buyers wouldn't just stand by. They're going to fight. They're going to fight. The sellers push. The buyers are going to fight until eventually buyers are going to give way, because we are actually looking at a new trend being formed. So wherever the new trend is going to be formed, be it uptrend or downtrend, we always see a heavy area where the market retests to try to continue the former trend until they finally decide to give up. You know what? We can't make it, be it buy or sell, and then you see the full trend being formed. All right. As I said earlier when we started, this has just about 16 slides for this pattern. It is a simple pattern, but it is a very effective and efficient pattern. So again, we have the horizontal way, and with it here being horizontal, we can see that the left and right shoulder is, we can see that the left and right shoulders are about the same level when the head and shoulder pattern is at a horizontal level, right? Our neckline when it is horizontal. This is easier to identify than the others, right? So we move from an uptrend, we retest that area of support. The buyers decide, no, we're going up. Sellers say no, we retest that area again. When the buyers decide to get in, they just get to the point of where they were previously, that left shoulder. The market breaks through, retests, we enter here, and the market goes down. Right, so this is for our horizontal one, right? This is how we trade it here, what it looks like here. We break out here, on the retest, we enter here. Horizontal level of support. Right? This is it in reality here. Again, what we have to do is to look at this pattern and be able to look at the candles to identify here. So we can maybe start entering or start learning this pattern just by drawing lines on the candles. So we look at here, that's an option. I just draw a line on the candle here. I draw a line. We could just start by just drawing lines. Any of the direction, let's just draw to see what it looks like. And eventually by staring it, we're going to realize, okay, this is that pattern, this is that pattern. So even if we decided to start over on that side, okay, I'm going to just draw up. Well, we have that come down here. This is some consolidation, so we're not drawing anything here. We go up with this one. Look at it, it came down, and we just follow it here. What is key that is going to give us the indication that we're actually looking at a pattern would be our area of support and resistance. So that's why it is key, what we call our neckline in this case here. We have to draw these areas of support and resistance so that the charts can make a lot more sense. They can stand out, they can speak to us. So even before we draw lines following the direction of the candles, we draw our support and resistance line. And then once we start tracing out the direction of the candles, we are going to be in a position to identify those trends here. So this again is done manually. Now we have this other head and shoulder pattern. Look at it. It is not horizontal as the previous one, but this one is slightly tilting up. And as we said earlier, this is about the most effective one here. Because we are looking for a downtrend, we even can get in at a higher entry price here. We still have the left shoulder being formed. We have the head, we have the right shoulder, we have the breakout through that area of support, we have the retest, and right on the retest, we are able to execute our trade. Let's look at it again. I mean, it's easy to identify now, as I say, because they're already identified, they're already drawn. But we have to be able to look at the chart and to practice and be able to start drawing that. As I said, that's just how it starts. You draw your area of support or resistance, and you just start tracing lines. So you start here, you just draw a line up because the market went up here. From that point here, let's just see it. Let's just go down. Let's just go up, and you just follow the candle, and let's see what patterns you can see. And eventually you're going to be in a position where you can even just look at the chart without even having to draw out or trace out these lines and identify the patterns that are there. So this is our upward diagonal head and shoulders. Same principle applies. It broke out. Look at this. This was a strong breakout. Remember we said earlier, the faster it climbs, the higher it climbs, the faster it falls. So look at it. Look at the amount of movements here. We went up, come back down to the neckline. It went up, and it happened rapidly, right? Whatever the time frame, this is our 10 minutes. Here, whatever the time frame here, look at the short duration of time we would have climbed so high. This is why it fell so quickly. And even in falling, it didn't even get a chance to retest back to the zone. It came down, look at that candle. This candle broke out. It closed here. It just went back a little up and then all the way down. We had a little retracement here, and then the market went down. So there is no uniform way that say it has to follow this thing 100%. But the closer we get to identifying it and looking at the uniformity, we are in a better position to understand that this is the exact pattern that we are working with, right? So we looked at the upward, and this one here now is in the downward trend line. So in a downward pattern here. Same principle applies. Our left shoulder back to retesting that trend line here. Our head back to retesting. Our right shoulder breakthrough, retest. We enter here for the sell. So it is very important that we look at the historical data of our trend line, because this is what's going to give us the indication that we have those things being formed. So we always connect the dots, as we say, we connect the tips, and we can see exactly what's going on here. So we had the horizontal, we had where we had it, the trend line or neckline going upwards. And then we have it here with a downward neckline. Again, the horizontal is very accurate. They're all very accurate, but with the upward trend line, it gives you a lot more value. Why? Look at this here. If we look at the downward, where you may enter down here, if the trend line was the other way up, it meant you'd have been entering up here. So this is why it gives you a greater value when the pattern is up rather than down. So down we enter at a lower rate from the shoulder, right? Lower than where that shoulder, that right shoulder is from. So that right shoulder ends here. But if we go back to this case here, look here, our right shoulder ends here. So our entry point is higher. This is why we are going to be able to maximize on what we would have done, the pips you would have made in this. So it's the horizontal, is the upward neckline, and it's the downward neckline. And these are the major patterns of the head and shoulder. Again, as I said when we started, There are persons who all they look for is just pattern. If they can't see a pattern, they don't trade. And when they find these patterns, they trade the patterns because of the accuracy of these patterns. But the head and shoulders is a very, very accurate pattern for us to master. And again, it is found when a trend is changing. So when the uptrend is about to change into a downtrend, we have that being formed. So this is where we have our head and shoulders, and we take note that once we identify this, we can safely get into the trade. So we look at it, we monitor it, and after the right shoulder is formed, it breaks that support area, which we call the neckline in this case, and it does the retest. We know we can enter for a sell without the shadow of a doubt. This is how accurate this head and shoulder is. All right, and this has taken us to the end of what slide? 16 slides. When we started, I say it was a very short presentation. Do you have any suggestion, any question, any comments?
I'm good, thanks.
Is there any of the slides we want to go over?
This one here that you just have up with the breakout. There's a previous slide where you put breakout, that's where you enter the trade. But then again, it said, I just want to clarify.
Right, okay, good.
You enter at the retest.
Right. So yes, so and what happens? So you answer the same question you asked. So yes, it break out here, but even though it breaks out here, remember we look for the retest, and most of the time the retest comes right back to that line here. In this case, let me start. Let's view 1 second. Let's view from current slide. Slideshow. Play from current slide. Right. You see the screen, right?
Yeah.
Okay, right. So I'm going to go away, but I'm going to go right back to show you something here. Good. Look at this here. On this horizontal one here, whatever that price is, the price is fixed on that line here. So it breaks out, we get a retest to enter, it comes back, it retests on the line, right? Maybe a little closer, maybe a little lower, sometimes it even just passes it just a little, but the retest come around that same area because we are looking at a horizontal. So right where we break out, that's maybe our point of entry when the retest happen. So we don't go in on the breakout, but because we know the retest is coming, we wait for the retest, and the retest most times comes back to the line where it break out. It doesn't always, but more than often it does. So this is why we're going to enter. Our entry point will be on our same area where we break out. That is when we have a horizontal neckline. But if we move to an upward, look at it here. So the market is going up. Let me just get the identical chart good, right? So look at our neckline is going upwards. It means that if it breaks out at this rate here, when it retests later on, it's going to retest on the line, but the price is going to be higher. So it comes on that same trend line. If it retests up here, when the line reaches here, it means it's going to be higher than down here. So our entry, although it is on right where we break out from the neckline, but it may not be the same rate because the neckline we're looking at here, our support is diagonal, it is tilting upwards. Also, when we look at this downward one here, if it breaks out here, when it breaks out and it retests later on, because we are on a downward tilt, it is going to retest at a lower rate, but on the same trend line, on the same line. This is why we have all this confidence when we draw a trend line. The market comes to our trend line and it goes back, comes to our trend line multiple times. So our trend line is also an area of support and resistance. We more or less look at, when we hear the word support and resistance, we think of it like this, horizontally. So it's trying to go past it, it's bouncing and come down, that is resistance. It went above it, it's trying to come below and it's bouncing, this is support. So we tend to see support and resistance just as a horizontal line. But this diagonal line here, which can be a trend line, also acts as dynamic support and resistance, because whenever the price comes to the trend line, it comes back down. Look at it here. Look at that downward movement. That candle, it goes up, it hits the trend line, it comes down. It goes up, it hits the trend line, it comes down. Look at this one come down. This next candle goes up, it hits the trend line, it comes down. It goes up, trend line, down. So the trend line also is an area of support and resistance, just as we have this horizontal one here. So this is why when we are talking about this area here, we are looking at this support line here. If it is pointing upwards, it means that when the retest is done later, it's going to be at a higher rate. This is why it is said that this pattern, when it tilts upward, yields the most result. Why? Because we are going to enter at a much higher rate, as opposed to moving downward here. So we break out here and we're waiting for the retest. If the retest happen down here later on that trend line here, then we enter lower than where it was, but it is still on that trend line. Note also, the retest doesn't always have to come back on the trend line or on the neckline. Sometimes based on how volatile the market is, when it breaks, you just break and you go down. I think we have an example of that. Let me see if I can find it here. In this case here, look at it here. The market would have broken, the price action would have broken here, that neckline, break it, and we're looking for a retest back to the trend line, and the retest never came back to that line because the market was so volatile. When it breaks, it just decided to just come down right away. So we still have to monitor it here. We know that once we identify the head and shoulder, it signals a change in trend for a downward movement. So we have to monitor it. Once we see the break, we monitor for the retest. But if you realize you break here, next candle didn't retest all the way back to the line, we know, well, here's what, it is going down and down it's going. So just an area for us to monitor. That's what it is.
Another question, do you use Fibonacci? We can use Fibonacci stuff on a pattern when trading patterns like this.
On which pattern? You mean on any pattern?
Well, this one specifically, on any pattern, yeah.
All right, so to use the, and it's a very good question you ask, okay? To use the Fibonacci, firstly, we have to identify trends, right? So you don't just pull a Fibonacci just anyway to know, well, which direction am I looking at? So in this case here, we can pull a Fibonacci from the bottom of this trend line here, from the bottom here to the top. And if we pull from the bottom to the top, and I look at the retracement here, the distance from here, pull back, that is just around, maybe just around the 50, around the 50. Look at it here. So we pull the fib from bottom here to the top. He's going to show us the retracement here, which is just around the halfway mark. He's going to pull back to around the 50. And he pull back around the 50, and then the market, the trend continues. It's going to go up, right? Let's see now. So we have from here to here, when we pull the fib, we realize it retraced about the 50. It went all the way up there because we need a high point and a low point. We decide to pull the fib from the bottom here to the top up here. Look at what's happening here. We pull the fib from the bottom to the top here. We get a retracement. This retracement will be just around the 38. That's where this retracement is going to be a key area again on the Fibonacci. So our first one formed the 50. It went all the way up to make the head. Our second retracement we would have done would be around the 38 here. And we're watching to see what happens. So in that case here, the Fibonacci wouldn't really help in that light here, because when we get to this point here and we see the retracement comes here, we're looking for the market to continue. But then when the market reached here, the market decided the market wasn't going higher than that. The market came right back down, continuing here. So we could end our FIB retracement even at that point here, because now the market moving a downtrend. So we can't pull the FIB from the bottom to the top anymore. Because it would have gone in a downtrend, you now have to pull the FIB from the top to the bottom to see what the retracement is going to look like. So pulling the FIB from here, from the top of the right shoulder to the bottom down here, we get a little retracement. This looks around 30. If we move from here to here, 50 would be around that area here, right? So we look at around 38, and then the market continue going down. So the whole thing to prove the FIB, I mean, we know the FIB is very accurate. It's just a matter of just trying it out, just testing it out. You look at areas, but you need a high and low to be able to pull the Fibonacci retracement. This little area here, there is no activity in this area here for us to pull a FIB, the FIB tool on it here. We could try from here to that point, you're going to give us here. We try from here to that higher point up here. We see what the retracement looks like here. So there are some areas where the Fibonacci would not work if we don't have a clear direction. We can pull it from all the way to the top of the head to down here. We can do that. You want to pull a FIB from here, we can take it from the bottom here to the top up here to see what the pullback is going to be. But a FIB wouldn't work from right here to that area here. No. It needs a distinct low to a high or high to a low. So we can all remember again, in all the previous patterns that we looked at, the key areas is at support and resistance level, at key Fibonacci retracement levels. So it is also important that we can use the Fibonacci retracement to get those key levels that are being formed. So we don't rule out the Fibonacci, but there are times when the Fibonacci cannot be used based on what the pattern is all about. All right, do we have any other question? It's on any of the slides. We have this downward one. So you just start off by, as you know, children would trace something, you just draw a line. I'm going to draw a line down, I'm going to draw a line up, I'm going to draw a line. So you just draw a line and see what shape is being formed. But what is going to tell you exactly what the pattern is key support and resistance line. This is what's going to tell you. Because if you don't have that neckline here, all you see is just a mountain, some big mountain, some little mountain. But it makes sense when we draw in that support or resistance. This is when we know what it is. It's a matter of learning it, and the only way we can learn is just by us just randomly just drawing lines, just drawing lines, just draw lines, and then it's going to come. When you start identifying it, you realize we can see those things on any chart. Any question? Anything? Are we okay for now?
I'm okay for now.
Okay. All right, so as I said when we started, this was a short presentation. It's just 16 slides we had, and it's just basically just one pattern for us to consider. So we can look at it. I'm going to upload it. We can review it, and we can just get on the charts and try to identify those patterns. But to identify patterns, any of the patterns, you just start by just drawing lines on the chart. And believe it or not, it may seem time consuming, but it's going to save you a lot in the end, because really and truly trading is all about patterns and strategy. A strategy is actually using a pattern. So if you master identifying the patterns and you know how to trade the patterns, that's what it is. So you're not just jumping and getting in and getting out, but it's identifying patterns. And once we can identify a pattern, we know how it behaves, we know what to do. So in a case like this, If you identify a head and shoulder pattern, you know it's a change of trend into a downward trend, it is going to go down for a while. So you may not put your stop loss as close as you would otherwise, because we know here's what I'm going to give it some room because it may have some heavy retracement, but I know the pattern is going to go down. Bottom line, that's what it is.
Okay, thank you.
All right, no problem. All right, so I'm going to stop share and we're going to say good night to everyone here. I'm going to just upload it when it's finished and put it on the site.
All right, good night, everyone.
Good night, everybody.
Okay, good night.
All right, good night.